Concept number 3, the principle of arbitrage. Arbitrage is undertaken when two assets produce identical results but sell for different prices. For instance, if there are two baskets of securities and both of them are going to generate, let's say, $100 in the future. As per the law of one price, the price of both these baskets should be same as on today. And for any reason, if let's say one basket is trading as 90 and the other one is trading at 89, in that case we say that the security is mispriced and there is an opportunity for arbitrage. So how is this arbitrage transaction executed? Let us understand with this example. This is an example of cash and carry arbitrage where it is usually done in case of contango market. Futures and forward price is higher than the spot price. So when we see that the prices are rising, we would want to buy the commodity or the asset today and would like to sell the commodity or the asset in the future at a higher price, right? So that is buy low and sell high. So the first step will be to borrow the money that is required. Okay, so whatever investment is needed, you are going to borrow it. You are not going to invest any equity in this case. So if the product is currently sold in the spot market at 100, then you are going to borrow 100 from the bank. The interest rate is 10%. And today itself, if you see that in the forward market, it is being sold for 120. Take a short position in the forward market, which will allow you to sell the product in the future at 120, and it is a commodity for which there is a storage cost as well for, let's say, $5. So at the expiry, you will be able to sell the commodity at 120 because you have entered into a forward contract. So taking this money, first you are going to repay the bank with the interest 100 plus 10, that is 110. And even after paying the interest cost, you will get some profit, that is 120 sale price minus the purchase price along with interest cost, and then reducing the storage cost leaves you with $5 profit. And this is arbitrage profit because at the time of the initiation of the contract, this was guaranteed. There was no risk involved at any point in time. And this profit was made possible only because there was a mispricing in the forward market. Had the price of this forward been 115, in that case the arbitrage profit would be 0. That means there would be no arbitrage opportunity, right? And when more and more arbitrage would exploit this situation, in that case the forward price will automatically adjust to the price of 115 and this mispricing of instrument will be corrected. So this was an example of cash and carry arbitrage. This is called cash and carry because in this case you purchase the asset in cash and then you carried it until expiry of the derivative contract. That is why it is called cash and carry. There can be another situation where we do reverse cash and carry arbitrage. This is usually done in case of backwardation market when the prices are falling. So when the prices are falling, you would naturally like to sell in the spot market and then you would like to buy in the futures market, right? So this is just the opposite of what we did in cash and carry. First you would sell the commodity. So by selling the commodity in the spot market, you are going to get some cash. You will deposit the cash in the market at some interest rate, and to close your position, you are going to buy a forward contract. You are going to take a long position, and since the prices are falling, so you are going to get this for a price lower than the current market price. Okay, so let's say the price is 90. So on expiry, you will withdraw the money from your deposit account. That will become 110. Out of this, you buy back the commodity because this forward contract requires you to buy the product at 90. And even after paying 90, you are left with a profit of $20. Note that derivatives are priced on a no arbitrage condition. That is when the derivative instruments are priced. These are done in such a way that there is no arbitrage possible in the market. Limitations to arbitrage: there are significant transaction costs, which makes it difficult to earn profits out of mispricing. Secondly, it requires very large amount of capital because, as I said, that the profits are very marginal and to make a good amount of profit you will have to enter into high volume of transactions, which requires a large amount of capital. Yes, I said that there is no capital requirement in case of arbitrage because it is usually borrowed, but at least you should have the borrowing capacity, right? Then it requires additional capital down the line to maintain the position. Many times it happens that you have to square off the position multiple times until the expiry of the contract, so that requires to maintain additional capital. Fourthly, it may require shorting of assets, which is difficult in case of real estate and other physical assets. And lastly, it may entail significant risks such as modeling risk. Concept number 4, replication. This means synthetic creation of assets. That means combining two or more instruments to get into a desired position. For instance, you want to replicate the returns of S&P 500. So in order to do that, either you buy all the securities in the index, but that is going to cost you a huge sum of transaction cost and also a very large amount of capital. So as an alternative, you can buy a futures contract in the S&P 500 that is also going to replicate the returns of S&P 500. Yes. So there are these replication strategies that you can long an asset and short a derivative. The combination of these two will lead to a position that is equivalent to a long position in a risk-free asset. That means buying the asset and shorting the derivative on this underlying will create a position that will be equivalent to investing or lending in a risk-free instrument. Okay, you just remember this first strategy and then you can just transpose these variables on the other side of the equation to create the other two strategies. Okay, asset minus risk-free asset is equal to derivative. Positive symbol means that we are going long and negative means that we are going short. So longing on an asset and shorting a risk-free asset, which means borrowing money, then this will create a position equivalent to a long position on the derivative. Similarly, shorting a derivative and shorting a risk-free asset, that means borrowing money, is equivalent to shorting an asset. Keep this in mind as you may find a question on this. Concept number 5, pricing versus valuation. What is price? Keeping a forward contract in mind, then we can say that the fixed price at which the transaction will take place is the price of that derivative instrument. That means if it is a forward contract, then the price that we have mentioned in the contract at which we will do the transaction in the future, this amount is called the price. And what is value? Value is what fluctuates in response to changes in price of the underlying. That means at any point in time, what is the price of the underlying? Whether the price is 85, it is 90 or it is 105, then these prices of underlying compared with the contract price will determine the value of this contract. In short, we can say that price is always fixed, but the value keeps on changing depending upon the price of the underlying. Concept number 6, pricing and valuation of forward contracts. Price of forward is what? The fixed price at which the transaction will occur, as we have just seen. It is determined at the initiation of the contract and will not change over the term of the contract. And how is it determined? Forward price is determined as spot compounded with risk-free interest rate for the term of the contract. Okay, if you have understood the concepts 1 to 5, then you must have already understood the logic behind this, right? Remember concept number 2 where we have learned about pricing the underlying, right? Which was something like expected spot price divided by the discount rate, right? I'm ignoring other parts of the equation, right? So you just flip this equation and replace this expected spot price with the forward price. Then what you get is forward price equal to spot price 1 plus RF, right? So this is the equation that we have here. But the key thing that needs to be emphasized here is that the compounding rate is a risk-free rate. Why is it risk-free? As we have seen in the case of replication strategies, that you can combine various instruments to create such a position that it generates a risk-free return for the investors, right? So in the derivatives market, all the instruments are priced in a way that it is a risk-neutral price. Remember concept number 1 where we see that risk-neutral investors only expect risk-free rate of return. And this is why in the derivatives market, no matter what is the instrument, be it futures, swaps, etc., whatever be the instrument, in each and every case we are going to take risk-free as in all the cases. Okay. Now this is the simplified version of the equation for the forward pricing. In the second equation, you see that we have also introduced benefits and costs. So the final equation looks like this. That means forward is equal to spot minus net cost of carry and then compounded by a risk-free rate of return. Coming to this example, spot price is given at 120, risk-free rate is 2%, calculate the no arbitrage forward price. All prices are no arbitrage prices only, okay? For a 1-year contract at initiation. So simply you are required to compute the forward price. In this question there is no benefit or cost involved. So simply 120 and compound it for a period of 1 year, and what you get is 122.4. In the next question, spot price is 120, net cost of carry is $3, risk-free rate is 2%, and calculate the forward price. So in this case, net cost of carry has been introduced. So 120 minus this net cost of carry is reduced in the formula. So minus 3 and compound it for a period of 1 year. Okay, and this gives 119.34. Spot price 120, net cost of carry is minus 3. That means cost is greater than benefits, right? So the forward price will be 120 plus 3, right? When cost is greater than benefits, then it means it is a contango market, and in case of contango market, the forward curve is upward sloping, right? So the forward price is greater than the spot price. So this is 120 plus 3 and then compounded for a period of 1 year. This gives 125.46. An asset currently trades at 100 while the 1 year forward contract price is priced at 120. Monthly carrying cost is $5 and risk-free rate is 10%. So the question should be, is arbitrage possible? Simply find out what should be the forward price as per the equation, that is 100. Then we have cost associated with the underlying, but we do not have any benefits, so benefit should be 0, and so the net cost of carry will be positive 5. Actually the net cost of carry is negative 5, so you can write it this way, and then we can compound it with the formula 1.10 for a period of 1 year. Okay, and this gives 115.5. So the forward price should be 115, but it is currently at 120. So yes, arbitrage is possible. So what should you do in this case? You should do cash and carry arbitrage. Okay, cash and carry. Coming to the value of a forward contract. What is value? It is the amount that the counterparty would pay or receive to get out of its forward position. We have seen that the value keeps on changing over the term of the contract. At the initiation, the forwards are priced in such a way that the value is 0. This is inherent in the definition itself, that at the initiation of the contract, the pricing is done in such a way that the value as on initiation becomes 0. Okay, so on this day, neither the buyer is benefited nor the seller is benefited. Both are neutral. However, during the life of the contract, the value of forward will be the spot price minus the present value of the forward price. So initiation is T equal to 0. Expiry is marked as capital T, and at any point in time in between is represented as a small t. Okay, so if on this date the parties want to offset the position, this is also called offsetting, that the parties want to settle the contract in between, then what should be the payoff? For that you need to find the forward value as on forward price as on this date. We know on expiry the contract will be made at F, okay, the forward price. So if we discount it for this period, what is this period? This is T minus T, right? Out of this whole T, this T has already expired. So the remaining is total minus what time has lapsed. Okay. So discounting it for this period, we get the price of the forward as on that date and then compare it with the stock price and we will get the value. Let us understand this with this example here. An investor took a long position in a 1-year forward contract at a price of 35. So F is equal to 35. Risk-free rate is 3% and what is you are required to find the value of forward contract after 9 months have passed when the spot price is 36. So as per this formula, the value of forward contract will be the spot price as on that date minus forward price discounted by 1 plus discount rate for a period of how much time is left. It was a 1-year forward and out of that 9 months have already lapsed. So only 3 months is left, right? So we can say 3 by 12 and this gives the value of 1.26. So that means if the contract is to be settled on this date, then this will be the payoff on this contract. And lastly, on the maturity date, the value of the forward will be spot price as on expiry minus the forward price.